Hi, welcome to Christensen Wealth Management. I'm Michael Christensen. Thank you for taking time to watch this weekly market update for the week ending Friday, August 17th, 2018. Before I jump into the charts and commentary, I would like to begin with the quote of the week. And this week's quote is from Edmund Burke. He was a member of Parliament in London. He moved from Dublin to London in 1750. He was an author, orator, political theorist, and philosopher. Edmund Burke once said, "If we command our wealth, we shall be rich and free. If our wealth commands us, we are poor indeed." Those are some wise words from Edmund Burke. Well, the rest of the past week has been another one of volatility. We had a bumpy day on Friday and on Wednesday of this week. And then Thursday, the Dow Jones Industrial Average took off like a rocket, had its best day in 4 months, but the S&P 500 and the NASDAQ just were not convinced by that rally. They both had a very lackluster day, light volume, and not a lot of enthusiasm. So it'll be interesting to see how we finish the week. Lots of chaos around the world when it comes to money, stock markets, and that is all resulting in a ton of volatility. The Chinese currency continues to be devalued, as I've been mentioning for weeks, and again, that just adds fuel to the fire. This dollar either has to go down and remove the pressure from the rest of the world, and if it doesn't, and the dollar strengthens, it is going to cause a significant amount of hardship around the world for many other countries. So we'll see where we go over the next few weeks to months, but dollar goes down. It is a stimulus to the U.S. economy, and pretty much will ease the pain on the rest of the world. Dollar goes up, well, the rest of the world is going to be struggling, and so will their stock markets. So with all of that being presented to you, I will begin with the charts, beginning with the Dow Jones Industrial Average. Let's take a look. Looking at this chart of the Dow Jones Industrial Average, you can see that the 5-day moving average in red right here is now back below the 20-day moving average in blue, which is a short-term weakness confirmation. That means over the last several days, the Dow has been getting weaker. It hasn't moved at all since, well, I guess we're back near the high here. So since July 26th, we're sitting right about there. And the 20-day moving average in blue is above the purple 50-day moving average, indicating intermediate term strength. So we have some mixed signals there, which says just remain cautious and wait to see if the Dow begins to fail or if it rallies back higher and we get a short-term strength signal again. We need to get that 5-day moving average back above the 20 before the concern is gone. So right now we are still looking at this high from February 26th. That is our source of resistance right now. That's the trouble that the Dow is trying to fight to get across, and it just doesn't want to do it yet. We're still hanging up here, and the Dow Jones Industrial Average is exactly where it was back on February 2nd. So not much there. The Dow has been pretty weak and very much sideways. And if you go even farther back, the Dow is right where it was on January 11th. So not much action here for the Dow. It had a good day today on Thursday, the 16th of August, but it just got us back toward the high from August 7th. So not much there. We need to get a breakout above that red line. Otherwise, this thing is just still stuck in a sideways range. We're continuing to use caution and some skepticism on the Dow Jones Industrial Average till we get more strength. Here's a chart of the S&P 500 stock index, and if I add the moving averages to this one, you can see that the 5-day moving average in red is above, actually, as of August 16th, which is today, Thursday, they have in fact crossed. So The 5-day moving average has crossed back below the 20-day moving average, which is a signal of short-term weakness. So remain a little bit cautious and suspicious on the S&P 500 for the next few days to see if this thing can continue to rally higher or if it continues to fail. But the more intermediate term timeline is looking much better. If I turn on the 20-day moving average and the 50, there we go. You can see the 20-day moving average in blue is above the 50-day moving average in purple, which is a signal of intermediate term strength because we have rallied since April 2nd. From that low there all the way up here, lots of short-term volatility in there, which is what the short-term indicator is all about. But over a longer-term time frame, you can see that the S&P has been rallying since early April. So there's some strength there in the intermediate term for the S&P. Just in the last week or so, the S&P has begun to roll to the downside on the short-term time frame. There is one other thing I want to bring to your attention that I mentioned last week, and that is the possibility of a bearish rising wedge pattern, which would not be good for people who are invested in the S&P 500 or things like the S&P anyway. Let me switch this over to a candlestick chart where each red and green rectangle represents a single day and represents the high, low, open, and closing prices of the S&P 500. What I mean by the rising bearish wedge is that if I do connect the highs from back here on June 12th and on July 25th and here on August 7th, and then I connect the lows from here, which is June 28th, as well as August 2nd, it appears, and draw that on up. I mentioned last week, which was we were in this wedge right about, let's see, Thursday, Wednesday, Tuesday, Monday. So we were this red candle right here on August 10th. We were still within the wedge, and we broke below it on Friday last week, rallied back up, and then Wednesday of this week, August 15th, we broke that wedge with a lot of strength. Lots of trading volume to the downside, which is not a sign of encouragement. And then on Thursday, we rallied back up a little bit, but on very light trading volume. So it looks to me like the S&P 500 may be on thin ice here, starting to lose its strength and break down below the wedge pattern. And we'll see if that in fact does continue over the next week. So stay tuned to the social media pages for Christensen Wealth Management, and I will post anything that is relevant to that particular pattern. Right now, I would use a lot of caution with the S&P, with the fact that the 5-day moving average has crossed back below the 20, and this bearish wedge pattern may actually be executing. Here's the chart of the NASDAQ 100 stock index. You can see it also is a strong index. The 5-day moving average in red is still above the 20-day moving average, but just barely. So we do still have a little bit of short-term strength remaining. And the intermediate term strength, which is represented by this 20-day moving average in blue being above the 50-day moving average in purple, is a sign of intermediate term strength for sure, and that's because of this nice rally that we have had since April 24th, which took us up here. And the only issue is that it's losing a lot of energy. The NASDAQ 100 as of August 16th has gone nowhere since July 12th. So it's been basically 5 weeks with no progress. And that's something to be a little suspicious about, but not too suspicious yet, because this NASDAQ still is holding on to its pretty solid trend line. And if I draw that trend line here, you can see that that is the line of support for the NASDAQ. Let me turn off those moving averages. So as long as the NASDAQ continues to stay bouncing off that red line, it's going to be okay. But if we break that red line over the next week or so and to the downside, then that is a sign of weakness and some trouble for the NASDAQ 100. So right now it's looking all right. We'll just keep an eye on it over the next week. Nothing to be concerned of at the moment. Here is my favorite industry sector of the week. It's the same one that I've been talking about for the last probably couple months or so, or 6 weeks. This is the S&P 500 Consumer Staples Stock Index. You can see that from the high of January 26th down to the low of about May 1st or 2nd, this particular index, consumer staples that is, lost 17.3% of its value, and it rallied sideways for most of May, and then the first week of June broke out of that declining trend, which is this top red line here. That marks the declining trend. You can see the trend began here. We touched it here, making the second point, touched it a third time, failed, and then the fourth time broke it. And ever since early June, consumer staples, the breakout being represented by this yellow oval here, consumer staples has just been on a absolute rampage for 2 months, just in this beautiful trend heading higher. It's looking great. So that's why consumer staples is my favorite industry sector. And my second favorite industry sector, which I introduced last week, is telecommunications. So let's go take a look at that one. Here is the chart of the S&P 500 Telecommunications Services Index. You can see that it peaked on February 1st of this year, fell 17% as well, similar to the staples, bottoming out on May 9th, rallied up, made a second point, which if you connect it with the first one is our declining trend, and we rallied up again, broke it back late June, rallied up a little bit, rolled to the downside, and tested that declining trend from above one last time on July 25th, and then boom, it just took off. So that is a very encouraging sight to see. This particular index is up over, let's see, $12, so over 5% already on this particular index in just a matter of weeks. So telecommunications looking really good for now and really powering with strength to the upside. And if I turn on those moving averages, of course, it's not difficult to understand that the 5-day moving average in red is above the 20-day moving average in blue and pulling away from it. So we have increasing short-term strength. And if I turn off that 5 and I turn on the 50, you can see that the blue 20-day moving average is also above the 50-day moving average in purple. So we have intermediate term strength as well. So telecommunications and consumer staples both looking like very good indexes at this time. Thank you again for watching this market update. Before you go, please do me a favor and click on the subscribe button on the YouTube channel, and then click on the little bell next to it so you'll be notified whenever additional videos are posted. And also in the top right hand corner of christensenwealth.com, you will see the Facebook, LinkedIn, and Twitter icons to visit those pages, and you will also find those links in the summary description of this YouTube video if you want to look for them there. So when you have some time, please visit those social media pages and like or follow Christensen Wealth Management while you are there. That way I can communicate with you throughout the week on social media and through these videos. Well, thanks again, and look forward to seeing you again in about another 7 days. Have a great weekend and another great week. Bye-bye.